The 4% rule is a rule of thumb popularized by retired financial advisor William Bengen, and for the last 30 years it has been the standard bearer for retirement planning conversations. However, some have recently begun to call its validity into question given the current economic environment. Will the 4% rule hold up in an era of high valuations, high inflation, and low, but rising, interest rates? Well, nobody can truly predict the future, least of all me. But if history is anything to go by, I would say that the 4% rule is probably going to be just fine. After all, it was built specifically to handle situations just like the ones we face today, if not worse. With that in mind, let's talk about why the 4% rule probably isn't dead yet. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a link to the investing platform M1 Finance. Get started investing for free today. So real quick, for those who don't know, the 4% rule is simply a retirement planning rule of thumb, which states that a well-diversified portfolio should be able to sustain inflation-adjusted withdrawals of at least 4% per year over the course of a 30-year retirement without running out of money. In other words, if you had a well-diversified $1 million retirement nest egg, history suggests that you could withdraw $40,000 of that nest egg in your first year retirement and then adjust that dollar amount every year thereafter to keep pace with inflation, and your money would last you at least 30 years. This 4% figure was determined by looking back at the historical returns of various types of investments, namely stocks and bonds, to determine how much a retiree could withdraw from their nest egg each year while guaranteeing that their money would last them at least 30 years in retirement. This is an important thing to understand about the 4% rule. It wasn't designed to work only in a good economic environment, or even a normal economic environment. It was specifically designed to work in the worst case economic environment that we had throughout recorded financial history. In fact, because of this design choice, it's far more likely that retirees actually following the 4% rule will wind up with more money than they had when they first retired than they are to actually run out of money prematurely. In fact, here's a chart showing the ending 30-year net worth of a hypothetical retiree who followed the 4% rule in retirement for every possible starting year since the late 1920s, using historical returns from Yale economist and professor Robert Shiller. The investor always started with a $1 million portfolio and had 60% of their money in a total U.S. stock market index fund and the remaining 40% in a total U.S. bond market fund. The ending net worths are adjusted for inflation. As you can see, the investor quite often wound up with more than their original $1 million left over after the 30 years had passed, despite the fact that they were regularly making withdrawals. At least in terms of this data set, about 70% of the time, that was the outcome. The average ending net worth was nearly $2 million. And the minimum and maximum figures were $11,700 and just over $4.8 million, respectively. This near-century-long period saw multiple market crashes, including the worst in American history with the Great Depression of the early 1930s, as well as multiple periods of high inflation and rising interest rates, particularly during the 1970s and early 1980s. And yet, the rule held up just fine, because those are the periods that the rule was built for. The late 1960s period, which came just before a decade that experienced multiple economic recessions and the market responses that often come with them in 1970, 73, and 1980, the highest levels of inflation we've seen recently, clocking in at nearly 15% by 1980, and interest rates that rose to around 20% on multiple occasions, was where the 4% rule came from. So while valuations are high right now relative to historical norms, and while inflation and interest rates certainly are things that are worth paying attention to, this isn't the first time that the 4% rule has faced such hurdles, even simultaneously. With that being said, what exactly could lead to the 4% rule breaking? Well, there are a few possibilities, but most of them boil down to one thing: something truly unprecedented happening. The first possible way that the 4% rule could be broken is if we end up experiencing an unprecedentedly low level of future returns on our investments. This is understandably something that some investors are worried about, given the high valuations we've been seeing in the markets in the recent past. However, when it comes to whether or not the 4% rule is still a viable starting point for retirement planning conversations today, one thing we have to understand is that there's a big difference between saying the markets may experience lower returns than they have recently, and saying the markets are about to to experience some unprecedentedly low returns going forward. One is an admission that it's possible that the near future may see some sort of regression to the mean, which would be totally plausible since most investment markets tend to work in cycles. The 2010s were, by and large, a pretty good decade in terms of returns. The decade started, after all, shortly after the bottom of the market during the Great Recession. On the other end of the spectrum, the 2000s were not a great decade for returns, at least in the stock market. So it's entirely possible that the 2020s won't match up to what we saw in the 2010s. But it's quite another thing to say that we're going to experience unprecedentedly low returns going forward. Don't get me wrong, such a thing is always a possibility, but the likelihood of experiencing near-term returns that are lower than the well above average returns we experienced recently is considerably higher than the likelihood of experiencing near-term returns that are lower than anything we've experienced in the past century. Keep in mind, during the Great Depression, the Dow Jones Industrial Average lost roughly 90% of its value. So that's the threshold we're dealing with here. That's the threshold that the 4% rule already survived. What's more is that it's often the sequence of returns that matters most when it comes to financial survivability in retirement, as opposed to the absolute returns themselves. For instance, take a look at this chart, which shows the market value of two hypothetical retirement nest eggs and the returns that they achieved in retirement each year. The chart assumes that both retirees withdrew $40,000 a year at the start of each year. As you can see, both John and Jane earned the same returns, just in a different order. John's best returns came at the end of the 5-year period, whereas Jane's came right at the beginning. As a result of this difference in order, known as the sequence of returns, Jane's nest egg is worth nearly $50,000 more than John's after 5 years. So if sequence of return risk is something that you're worried about, then there are a lot of things you can do in order to mitigate it. For instance, you could keep some of your money in traditionally less volatile investments so that hopefully you won't be selling at as steep of a loss should the economy stumble shortly after you retire. Or you could maintain a solid cash buffer that you could use to live on should the markets tank. That may cost you some returns in the short run, since that money would no longer be invested in the markets, but since it wouldn't be invested in the markets, it also wouldn't be subject to the same kinds of risks of a market crash. Or you could work and continue saving a little while longer. That would have the added benefit of continuing to build your nest egg and give you a little extra wiggle room, if that's something you're willing to do. The other thing that could happen under this unprecedentedly bad future returns umbrella is that we'll experience poor returns for an extended period of time. So basically something like we experienced in the 2000s, only for much, much longer. However, we run into the same situation that we did with the unprecedentedly poor returns scenario a minute ago. It's not that it's impossible for the markets to experience a dry spell for a really long time. But it's one thing to say that we'll experience poor returns in the near future, relative to the recent past, and quite another to say that we'll experience those poor returns for a historically long period of time. For instance, on an inflation-adjusted basis, the markets took a full 25 years to fully recover from the Great Depression of the early 1930s. This was due both to the fact that the markets experienced steep losses during the Depression and high levels of inflation in the 1940s. They were as high as 19.7% in 1947. But again, the 4% rule already survived this time period. So if we're going to break it, we'd need some combination of worse returns than the minus 90% or so that we experienced in the Great Depression, or a longer period of poor returns than the roughly quarter century it took to merely catch back up with inflation. Again, it is entirely possible for something like that to happen. Many stock markets throughout history have gone to zero after all, but I think you get my point. It takes a lot to be worse than anything we've seen over the course of the last century, simply because we've seen quite a lot over the past century. The second possible way that the 4% rule could be broken is if we end up experiencing an unprecedentedly high level of inflation in the future. This is also, understandably, something that investors have been keeping an eye on over the last year or two. At the time of this writing in August 2022, the inflation rate is hovering a little over 9%. That's higher than anything we've seen in decades. And you could argue that high levels of inflation is an even more damaging thing to deal with for the 4% rule than poor market returns are. By design, the 4% rule is simply an application of an inflation-adjusted withdrawal strategy. You withdraw a certain percentage of your savings in the first year of retirement, sure, but after that you don't take the value of your remaining nest egg into the equation at all. You simply adjust that original withdrawal amount for inflation each year. So if you withdrew 4% of a $1 million portfolio in the first year of retirement, you'd withdraw $40,000, and you'd have $960,000 left over. If inflation is 3% that year, then your withdrawal in the second year of retirement would be $41,200, regardless of whether your investments gained 30% or lost 30%. What this means is that even short-term spikes in inflation gets locked in to all future withdrawals, assuming you're following a very strict application of the 4% rule. Naturally, this will increase the likelihood that you'll eventually run out of money, so the concerns are definitely warranted. However, there are also a couple of things that need to be kept in mind. First is that, of course, this is not the first time we've experienced high levels of inflation, and we've certainly experienced them over much longer time periods than the year or two that we've been experiencing them so far in the 2020s. As I covered in the last section, we experienced double-digit inflation multiple times in the past, and we've had multiple decades where inflation was at or near those levels for most of that time. I don't know if we'll end up getting to that point this time around or not, but there's still certainly room between where we are now and where we've been historically, meaning that at least so far, there's no real reason to think the 4% rule is in any imminent danger. Second is that not everyone is going to experience inflation the same way. The Consumer Price Index, or CPI, is one of the most well-known barometers of inflation that we have, and it's the one that the 4% rule was built on. However, it's not necessarily going to match your own personal inflation rate in the real world. Sometimes you'll experience budgetary inflation that's much higher or much lower than the headline inflation rate due to things like spending more or less money on certain goods and services, or just financial decisions that you make. For instance, a bought and paid for home would likely lead to slightly less inflation in the shelter category of your budget than a renter would experience year in and year out. And in terms of the decisions that you can make, there are things like shopping the sales, substituting in cheaper alternatives for items that have recently seen major price hikes, tightening your financial belt when your investments are struggling, and cutting back on, or just delaying, certain expenses, just to name a few. And statistically speaking, this sort of outcome is not uncommon. In fact, most retirees see their spending increase at a rate that's slower than the overall inflation rate in retirement. This phenomenon even has a name in the world of retirement planning. It's known as the retirement spending smile, and it can have a pretty sizable and positive impact on the viability of the 4% rule in the real world. For example, here's how our chart from earlier would look if we assumed that a retiree's spending increased at a rate that was 1% below the headline inflation rate each year. So if inflation was 3% according to the CPI, our retiree would see their actual spending rise by 2%. As you can see, it's quite the difference. 91% of the periods in this dataset ended with more money than it started with, compared to just 70% in our original scenario. The average ending net worth was just shy of $3 million, compared to about $1.94 million in the original scenario. The minimum and maximum ending net worth figures were $542,100 and $6.75 million, compared to $11,700 and $4.8 million in the original scenario. So, if you make it a point to set your retirement budget up in such a way that you have as much financial flexibility as you reasonably can, you can make quite an impact on your personal inflation rate over the years. And because retirees are living on a fixed income, in the real world, this is a very common thing to do, even if the 4% rule doesn't necessarily account for it when looked at through spreadsheets. The third possible way the 4% rule could be broken is if we, as individuals, set up our finances in a different way than Bengen did in his study. There are multiple ways that we could do this, but perhaps the biggest ones are using a different asset allocation or investing strategy than Bengen did, having a different time horizon than he did, or just not following the rule as originally intended. For example, according to Shiller's historical return data, we know that a 60% stock, 40% bond portfolio has been able to maintain a minimum safe withdrawal rate of roughly 4% over the course of a 30-year retirement for any starting date since the late 1920s. However, if we used an all-stock investing strategy, say by just pouring everything into an S&P 500 index fund, we wouldn't have actually managed to maintain that 4% rate in the worst-case historical scenario. By my count, there would have been at least 6 potential starting years that would have run out of money before the 30 years were up, as you can see detailed in this chart. If we're trying to make our money last us longer than the 30 years that Bengen's study looked at, then we may also need to lower our withdrawal rate in order to achieve that 100% historical success rate. For instance, our 60% stock, 40% bond portfolio would have required a minimum safe withdrawal rate as low as 3.72% before any taxes and expenses come into play to make it at least 40 years in a worst-case historical scenario. But there you have it. The 4% rule is probably not dead, even in the current economic climate. It has never been gospel, There have always been other things to consider when trying to determine if it'll work out for you, or if another strategy would fit your situation and goals better, but it was designed to work in the worst case historical circumstances that we have data on. And while it's always possible for a new worst case scenario to be set, with nearly a full century of economic ups and downs already on the record, there are a lot of tough times that are very much part of the precedent. So it would take something truly catastrophic to break that mold. Only time will tell if that type of thing comes to pass in our near future. But if I were a betting man, it's not where my money would be. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.